From a young age, many of us are taught the value of saving money. We are encouraged to put what little we earn in a piggy bank or a shoebox and to save it for a rainy day. As we get older, some of us open bank accounts and do the same thing but on a larger scale. When choosing our bank, we think about a number of things. Which bank gives me the best rates? Are there any fees? Is there a branch nearby? Regardless of which bank we choose, we feel safe knowing that the bank will take our money and lock it away in their vaults, right? Not exactly. Banks are allowed to take a portion of the money you deposit and use it to make more money by spending it in the economy. The remaining portion of your money they must hold in the central bank or as currency. This is called the fractional reserve rate. For example, if you deposit $100 in a bank that has a 1% fractional reserve rate, the bank can take $99 of your money to invest or loan out to other clients. Your money can then be used by an entrepreneur to start a business or by a family to purchase a house. The full amount of the deposit is available for the depositor to withdraw at the same time that the bank has loaned out $99 to whoever got the money as a loan. When you take a step back, you see that there is suddenly $199 circulating in our economy instead of your initial $100. This is how banks create money. While the fractional reserve policy stimulates economic activity, it also presents a risk. What if everyone who deposits their money in a bank decides they want to withdraw it at the same time? Because the bank only has 1% of the depositor money in reserve, they would not be able to pay every depositor back in full. This is called a run on the bank. When banks run into trouble like this, they can borrow from the central bank to repay client deposits, or the fractional reserve rate can be adjusted to help mitigate risk moving forward. In the end, it is the amount of trust banks are able to instill in their depositors that ensures there isn't a run on the banks. In general, this lending and investment activity is also how banks make their money. The money they make through interest on these transactions is used to pay the interest on your account. The difference between the return on investment and the interest you receive is the net interest income for the bank. These loans and investments can take many forms. As a customer, you usually don't know what your bank does with your money, except for what you can learn from websites or annual reports. Your money could become a personal loan for purchases like cars, mortgages, or home renovations. Or it could help an entrepreneur grow a business by purchasing new machinery. It could also finance more controversial activities, such as the weapons industry or nuclear energy. Banks can give out your deposits to finance loans, but they also have a wide range of investment options in something called the financial economy. We see hedge funds, stocks, bonds. Within this range of investment options, there are investments that are more closely connected to the real economy, and some that don't connect to a physical transaction, but aim to make profits by speculating on price changes. Why is that a problem? The more speculative a financial product becomes, the more risky it is. In the 2007 to 2008 financial crisis, we all witnessed how banks were pulled down by their speculative investments. Governments jumped in to save failing banks because without a functioning banking system, our modern economy would collapse. Within this general framework, there are several varieties of banks. There are retail banks, commercial banks, investment banks, and central banks, all specializing in different types of transactions and client groups. Despite these different specializations, what all banks have in common is that they are regulated by local, national, and international authorities. The goal of this regulation is to provide oversight and manage the risks banks are taking with your money when it's out of the vault and circulating in the economy. Even more important is that proper oversight gives us the confidence to trust banks to make good decisions with our money. This trust is what keeps our economies running.